we broke it down into the four stages. The first one that we commonly see is the unprofitable stage, where a trader just is new. They maybe see beginner's luck initially, which gets them really interested in the markets. And then after the beginner luck fades away, they enter this unprofitable stage. The second one is boom and bust. The boom and bust is where you kind of figure out that this is not a casino. Beginner's luck has faded away, and you come to a realization that the market requires some, dedication and knowledge and experience. The third one is the consistency stage. This is where you've learned, I think the biggest thing you learn from stage two to stage three is that you can now control your risk. And when you get to control your risk, you can keep your large winners for longer spans of time. The last one is when you combine a good system with a high level of experience. You've combined the same diagram that we spoke about, where your knowledge is now stitched together with experience, and you really are focusing on, what works for you and what doesn't work for you.
First things first, establish a process, and that's key to transitioning from stage one to stage two. And the key takeaway is the goal is to transition from a random trading to a structured approach with clear rules.
Some things can never be taught, but only be experienced. So you can read all of the books, but when you get hit with a large gap down, for example, you will learn from that gap down, right? You can see a trader talk about his journey and how they stepped into a landmine and blew up their account. But when you actually do it for yourself, that's the best learning you will come across. One strategy, figure out your time frame, study the most winning stocks and the most, successful traders that you know or want to emulate. I think emulation at this stage is important because it allows you to refine your trading rules and your system. When you see someone else be successful, there might be a reason for that. Now you'll pick up bits and pieces from many different traders, and start to piece together your own system, which has like entries, stop losses, position sizing rules, and how you will, buy and sell in the markets essentially. Stage four traders still run into string of 6 to 10 to 12 losses in a row, but they have confidence their system and their process will take them through these losses, and eventually they will come out on the right side of it.
Let's dive now into the stages of trading, the kind of next key section of today's webinar. And Raya, I think you can take the lead with this one.
Yes. So this is one of the diagrams I came up with a while ago to is really based on the mentorship that I've done and Ross has done and Richard's seen. We broke it down into the four stages. The first one that we commonly see is the unprofitable stage, where a trader just is new. They maybe see beginner's luck initially, which gets them really interested in the markets. And then after the beginner luck fades away, they enter this unprofitable stage. Many of the common issues that we see and we've discussed is, one, they don't take their losses quickly. They're placing trades with no real system. They saw success in the markets, which was quite random, and they felt that randomness will continue, but it doesn't. And that's the first stage. The second one is boom and bust. So the boom and bust is where you kind of figure out that this is not a casino. Beginner's luck has faded away, and you come to a realization that, you know, um, the market requires some, dedication and knowledge and experience in it. In this boom and bust stage, you see really large wins, and that excitement equally is taken away when you see a large loss. So you have something that's kind of working. You don't know what it is yet, because you haven't kind of sat there and looked at why are your large winners resulting in huge, gains, and why are your large losses, you know, taking away all those gains. Some of it is psychological, some of it is system related, some of it is you're still building experience in the markets. The third one is the consistency stage. This is where you've learned, I think the biggest thing you learn from stage two to stage three is that you can now control your risk. And when you get to control your risk, you can keep your large winners for longer spans of time. But when you do have a loss of 3, 4, 5%, you curb that loss, which again allows you to have asymmetry in your P&L. And it kind of curve, you see your P&L starting to be a bottom left to a top right type of situation where it's trending in the right way over a year or two or three. The last one is when you combine a good system with a high level of experience. You've combined that the same diagram that we spoke about where your knowledge is now stitched together with experience, and you really are focusing on what works for you and what doesn't work for you. And that's the last stage, which is the performance stage. So each of these, I think the first thing that you guys want to do, maybe in the chat or if you're watching afterwards, is to just do an honest self-assessment of where you're at, right? Identify the stage that you're in, even in the comments right now. If you could put, if I'm in the unprofitable, boom bust, consistency, or performance stage, and I think that's the first thing that you could do is a honest self-assessment of where you're at. The second is to track, and a lot of traders tend to ignore this in the first two stages, is to track their equity curve. Your equity curve is a report card or a realistic measure of where you're at in the markets, right? And you could plot it, if you have a broker like IBKR, they will plot it for you. But you want to take a look at that equity curve to see what's happening. Is it fluctuating a little too much? Are you not able to handle the volatility of it? Do you have moments in the market that are amazing, followed by moments in the market that are not so amazing? But all of that assessment is all tied to tracking your equity curve, right? And the goal here is once you do that on a self-assessment and you track your equity curve, you can then progress from one stage to the next, right? And it will allow you to set a goal for yourself. Hey, I'm in the boom bust stage where I'm seeing large wins and large losses. Over the next 3 to 6 months, I'm going to take a look at why am I having these large wins? What's the reason? Most of it always has to do with market trend and being in sync with that. And then what happens with the losses. If I have my average loss be 8 to 10% in the boom bust stage, I can set a rule that says if I have a stock and it reverses on me more than 4%, right, I will cut that no matter what, right? That math will then skew in your favor. It will show in your equity curve. While you'll have large wins, you'll have smaller losses, and the math itself will work out. So that's what I kind of wanted to say here is to identify the stage you're in uh, and really do an honest self-assessment by looking at your equity curve.
Yeah, and I'll say one thing I found helpful when analyzing my equity curve is also plotting the QQQ or SPY along with it, so you can see how the fluctuations you're going through with your performance tie into the changing market dynamics. And that can give you insight to say, hey, I'm really good at picking the turn in the market, but when we transition back into a correction, I give it all back. I'm a boom and buster. So that can be really helpful as well. And then here are some other kind of leading questions that you can ask yourself. Do you have trading rules? A few people said no. A few people said they still need to work on them. This is part of transitioning from stage one to stage two is actually having a trading system defined, especially with risk management, that allows you to progress. So there's some simple, but not easy things that you need to do and implement to progress through your stages. And we'll get into even more detail about each stage and how you can progress in between them shortly. But I just want to say, that equity curve point I think is so important. These equity curves here are kind of templates that you can apply and look at and compare your equity curve to. Obviously, this one more downtrending. You've got often an initial powerful move that hooks you in. Maybe you caught Tesla with 100% of your account in 2020, but you just haven't seen that performance since. Then you've got the boom and buster, where maybe you participate in the uptrends, give it all back during the corrections, uptrend, correction, uptrend, correction, and overall it's kind of flat to even more downwards trending as well. Then profitable trader, you start to see higher highs and higher lows. You do give a lot back during corrections, but you're making steady progress and increasing your equity from left to right. And then the performance phase, and this is a phase which even the best traders are in. They're always looking to improve and get better and gain new edges. And even them might have periods where they're not trading well and they transition back to a boom and buster for a little bit of time. But their overall equity curve will be, you know, a clean trend, higher, lower, higher highs, higher lows from left to right. And they give a lot a lot less back on average during the corrections than the profitable traders in the consistency phase. So this equity curve and that analysis can really help you analyze and be truthful about what phase and stage you are in. So let's dive into and yeah, put in the chat right now or in the YouTube comments what stage you're in. I saw a lot of stage twos, a lot of stage threes. Saw stage 2.3, 3.14, 15926 in there, 2.718. So yeah, just try to be honest about where you are, which stage you're in currently. And I do see some stage ones, and that's perfect. Everybody starts there, and you can implement
It
stuff
can
very
move on.
quickly and progress. So you have the most potential if you're in stage one. So stick with it, have confidence, understand realistic expectations that it will take some time. But let's go ahead and dive more actually into that stage, and Ryan, maybe give it another description of
Yep.
it, and then we've got a slide about how to progress. So yeah, we'll start here.
Yeah, so stage one traders really have a few things. One is a lack of system. So entries and exits are completely random, often based on, I'd say, someone else's stock picks or tips. And there's a heavy level of emotion involved in their trading rather than strategy, right? The second that we've spoken about is there's just no risk management. There's no definitive stop loss, there's no definitive max loss, there's no definitive position sizing to control the math of your trading. And when you don't have that, it's all based on emotion, where an uptrending market, you'll swing for the fences, it will work. And as soon as the market turns a little sour, you will have a really hard time and you'll give back a lot more because there's no position sizing to skew according to market trend. Third is you're chasing, I would say, quick gains, right? So you're position sizing big with emotion, and sometimes it works, but 60 to 70% of the time it won't. And chasing quick gains will result in chasing quick gains is like when we buy a lottery, we're chasing a quick gain, right? How often do you win the lottery? You don't win often, right? The fourth is you'll have fluctuating styles. So the traders often one on Monday they are day trading. On Tuesday they turn into a swing trader. On Friday they're trading options, and Saturday, Sunday they've become a crypto trader because the market's open, crypto market's open, and the stock market's closed. So fluctuating trading styles, again, with anything, whether it's building a business, building your trading system, uh, you know anything requires laser sharp focus. And you don't see, for example, I would say, um, Stan Weinstein wake up and only trade stage analysis on Monday, Tuesday, and then switch to, let's say, VCPs the rest of the week, right? So Mark Minerini would not, stop trading his SEPA system because they're all laser focused on the system that they have built for themselves. There will be in stage one, there's still boom and bust cycles because that's what kind of keeps you in the market. You become a source of income is what I like to say for others because you have a lack of trading strategy, you have no risk management, you're chasing quick gains, and the money that you're putting into the market is being consumed by others. So you become a source of income for others. So some traders in this stage, when they commit to really learning, slowing down, looking at what they're doing, um, you know, this stage is all about like impulsiveness. It's all about a lack of structure. It's all about taking unnecessary risk when the market turns sour and you're just in a downtrend. So we can move to kind of, Richard, how we progress
Yeah,
from one
I
to two.
yeah,
Before,
I just
yeah, you can add some.
Yeah, so basically what Rye said, at this stage, you just have to commit to learning. Many of you I know mentioned, watching my interviews and watching our material, and that's perfect. But you have to go ahead and apply that. But read books, watch interviews, take notes, write your first set of trading rules, establish entry and exit criteria. what does a buy look like? What does a sell look like? Implement strict risk management. This is so important. Just this fact, having a stop loss on every trade is a big step into progressing from stage one to stage two. You want to develop a system as well for stock selection and entry setups, and you want to be as independent as possible. I think it's completely fine to learn from traders, but whenever somebody puts out a stock symbol or mentions something in a report, you want to interpret that through your own lens and your own process and not just blindly follow them. You want to try to learn from, why did they select that stock? What are they seeing? What are they looking at to pick that stock? So learn stock selection and develop your own process for yourself. Then, very similarly, adopt sell rules, have a clear cut reason for closing your trade, whether it's a break below the moving average or whatever. We're just trying to eliminate the randomness that is so rampant in stage one. Where everything doesn't have a rhyme or reason. It's based on fear, greed, emotions, social media tips, all of that, and just overall hype. So we want to first things first establish a process, and that's key to transitioning from stage one to stage two. And the key takeaway is the goal is to transition from a random trading to a structured approach with clear rules. That kind of sums everything up. Ryan, anything to add on this slide that you
Just
already?
say,
Yeah.
discipline and structure in your decision making will remove impulsiveness from your trading, which will allow you to progress from stage one to stage two.
Yep.
Yeah.
For sure. All right. So next up, the boom and bust trader, stage two.
So this one is character mostly it's about you have more knowledge now, right? But your execution and the way you go about trading is still a bit inconsistent. That's what results in big wins and then big losses. There's a lot of volatility in your equity curve when you analyze that and you look at, there's swings in the market or there's swings to the upside in your equity curve, but then you give it away. And the primary reason for that is you're still developing your risk management skills, right? You're still developing that you're still coming to terms that you have to take your losses quickly, essentially. Um, Stage two also kind of heavily depends on, I would say, less about developing feel for the markets, but you're very heavily reliant on, an indicator or two, and you haven't come to the fact that there's a little bit of an art to trading, right? No indicator will be successful all the time. You're using the same strategy in a good market and a bad market, and that's mostly because of a lack of a market cycle system or a lack of awareness of how a good market is something that we saw late last year to early this year, and a bad market is the one that we're in right now since the last 14 days or so. So the more stage two traders when they kind of lack the awareness of that the fact that the market is cyclical in a way. And when they figure that out, that's how they become stage three. So I think those are some of the characteristics for stage two um, as well. So I know you have the transition slide up, Richard, if you want to go first, and I'll add some
Yeah,
things.
just wanted to double click on what you said. I think building a market cycle system and having that awareness about are we in an uptrend or downtrend, very simply. Because, like you said, I think stage two traders take the same actions, whatever type of market they're in. But depending on the market is what the results will be. So you can buy a breakout in an uptrend and be rewarded, but that same breakout is going to get stuffed if we're in a downtrend and institutions are distributing overall. So I think that's really key here and almost should be in bold. Also, I think narrowing your focus as well, really refining your system, I think is really important. Probably a lot of stage two traders, they're gaining all this information, which is great, but they're trying to trade an earning gap. They're trying to trade a VCP. They're trying to trade a pullback to a moving average. They're trying to do all these things at once, five different styles, five different setups that are all a little bit similar, but need overall, mastery to really be traded well. So focusing on just one or two and probably just one to start is probably key here. I think at this point, transitioning from stage two to three, also studying winning traders, what they do well. And again, not blindly following them, but studying what they do, their process, really their routines, all of that, how they approach the market is more important than, their setup or what, what their results are. And also studying previous market leaders. We put out a TraderLion model book every year. We're about to launch one with Stan that basically analyzes the market based on our methodology and how we would have applied buy rules, sell rules, risk management, all of that. And you'll learn so much by going through previous charts of winners and notice setups and opportunities and patterns that then you can use as a template, a blueprint going forward. Then an increased focus on leading names. I think also there's some shiny object syndrome with stage two where they're focused on any stock that's moving, whereas stage three traders and definitely stage four are a lot more laser focused on the top opportunities. Maybe those top opportunities aren't set up right now, but they're patient. They're waiting for their spot to apply their entry setup, entry tactics to get into those leading names that have the greatest potential overall. Then again, here this is part about building a market cycle system. Refine your trading rules based on added experience that you've acquired, and then still focus on risk management. Risk management is key. Making sure you've got that nailed down is key to going from stage two to stage three. And kind of the key takeaway here is the focus shifts from gaining general knowledge to mastering one approach, and refining execution. So I think these are some key things to work on. I know a lot of you are in stage two right now that commented and are watching this right now probably. So pick this up right here and focus on that. Pick focusing on leading themes and working that over the next few months. Pick one of these things and apply them all over time, and that's how you'll progress from stage two to three. Ryan, anything to add based on what I just said?
No, I think, one strategy, figure out your time frame, study the most winning stocks and the most, successful traders that you know or want to emulate. I think emulation at this stage um, is important because it allows you to refine your trading rules and your system. When you see someone else be successful, there might be a reason for that. Now you'll pick up bits and pieces from many different traders, and start to piece together your own system, which has like entries, stop losses, position sizing rules, and how you will um, buy and sell in the markets essentially. And the last bit of it, I think the progression from two to three is also just experience. Um, Time will kind of heal all if you can survive in the
Yep.
markets. Time will heal a lot of your mishaps, um, and you'll learn, a good market from a bad market. And some things can never be taught, but only be experienced. So that last part of it includes, building that experience to get to stage three. So you can read all of the books, but when you get hit with a large gap down, for example, you will learn from that gap down, right? You can see a trader talk about his journey and how they stepped into a landmine and blew up their account. But when you actually do it for yourself, that's the best learning that you will come across in the markets. And those things, like we said earlier in the webinar, is those will happen and expect them, and you'll be much better on the other side uh, to transition to stage three.
Yep. All right. So here's stage three.
Stage three, I would say some of the most important things in stage three is one thing about getting through one and two and getting to three is you have some sort of passion for trading the markets. So you're committed, you're highly committed to learning. For me, stage three was I read a lot of books, ones that included trading journeys, ones that included trading psychology, ones that included systems that I knew I could never trade because they don't align with my lifestyle. But I was committed to learning everything that I possibly could that exists out there. And that still kind of happens, every time there are new books that come out. I tend to do that because I enjoy it, I'm passionate about it, and I'm committed to, you know, getting any sort of edge that I can possibly get. Second one is I think it's important that if you want to kind of expedite your stage one, two, and your stage three to look for mentorship and guidance that exists. If someone's been there and done that, or if you want to learn golf from someone, it's pretty clear who you would go to. If you want to learn basketball from someone, you would go for the best mentorship and guidance that exists. And I think some of it gets a bad rep, but mentorship and guidance for me personally, early on was Mike Webster. then Ross Haber, um, and Stan
Now me.
Weinstein. Uh, um, like all of these people have played a really key role, right? A recent example, and I always have been saying this, is I was searching for a reversal setup to kind of add to my toolkit, and I researched, I tried everything. I did that, and then it all clicked with while being, look when we were doing the stage analysis master class, right? The 4B minus, and that was through mentorship and guidance, where Stan was directly involved in that, and I think many traders should seek that because it will kind of shorten your time span, but it will get you where you want to get to a lot quicker. So stage three also involves consistent, execution of your system. And the biggest one is you're now aware of the market and how it trades in cycles. You have a market cycle system, which we'll speak about extensively in future webinars. You have a system that will get you into the markets, keep you in the markets, and you'll also have how to get out before things turns really, really sour. So you'll have a clear market cycle system. You're aware of when you want to step on the gas and you're aware of when it's time to step back because nothing that you will do aligns with your system, and you don't want to give that money back. And that's really why the equity curve is dancing from the bottom left to the top right slowly in stage three. um Richard, you want me to speak to just improving as well? Like stage two, you know, transitioning or uh, getting to stage three, it's all one setup or one strategy. You're focused, you're highly focused, and you're specializing in one thing, right? Um, the other thing is risk management. You have a clear expectation of you will take your losses when they need to be taken, how you will position size, which I think, stage three to four, it gets even better in terms of position sizing. And your confidence in stage three is growing, right? It's getting better and better because success breeds, I'd say, confidence. Like when you see a gain, you know that, okay, I know why this happened, and if I can emulate that a lot more and your sizing will get a lot better, you will get to stage four that way. So um, that's what I wanted to say for that.
Yeah, I think from my interviews and talking with a lot of traders, I think the position sizing is a key thing that unlocks that next level performance, but you can't just jump into it. And I think I say somewhere on these slides, it's like weightlifting. You don't go to the gym and your first session you can bench 300 pounds. Like you, and most people never get to that, right? You have to build up to it. First, you master the technique. First, you bench the bar. Then you eventually work up to putting your first pair of 45s on the bar, and you progress from there. So you have to earn the right to put on more weight, and similarly you have to earn the right to size larger in the markets. But that sizing leads to the strong performance because these traders who are transitioning from stage 3 to stage 4, they know exactly when to size larger, what names to size larger as well, what time in the market cycle to put on larger positions, and they manage risk expertly throughout the way, along the way. So I think that's a big key that enables that next level of performance. But again, you have to work up to it. You don't want to try to jump from stage 1 and stage 4. You don't want to size like Mark Minervini when you just started trading. That's a recipe for disaster because you haven't mastered the fundamentals that build up to a foundation to be able to do that. So I think that's really key. So here's the performance phase. Right, anything you want to add on the performance phase here?
Um, in the performance phase, it's not like the be all end all type of situation. All you've done is you've gone through the paces or through the ringer in stage one, two, and three, and you've mastered your some system, right? So if we look at successful traders, Stan Weinstein built the stage analysis system. He still trades that to one, today. Minervini built the SEPA system, which was heavily influenced by William O'Neill, growth stock trading, Wyckoff, and things of that nature, right? Um, Stage four is about doing your routines when the market is in a downtrend, not only when the market is in an uptrend. So you've built this high discipline because you know that when the market is ready, you have to be ready for the high potential stocks because if you don't do that, you will lag. So there's a high level of discipline regardless of situation in the markets. You know when to be aggressive. I think the biggest thing is you figured out, you know, um, early in a market trend, your position sizing will be a lot heavy because you'll see a big increase in breadth in the markets, for example, and you'll make that initial progress because everything in the market or the market floor is lifting higher, right? And when things don't work, and stage four traders still run into string of 6 to 10 to 12 losses in a row, but they have confidence that their system will ride, you know, their system and their process will take them through these losses, and eventually they will come out on the right side of it. So they don't start changing their system just because they've had 3 or 4 or 5 losses, let's say in a row. So it's important to understand that stage four traders still have losses. But over time, as you're in stage four, you learn to be selective and really patient and wait for the right conditions. Even if that means you're not trading for the next 2 months or 3 months, and they will wait, 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 and wait. And when the time is right and they feel like everything's in their wheelhouse once again, they will use position size as leverage to catch up in performance. Or if it's the only thing, the only way they're making an income, that selectivity and that patience will allow them to um, make the money that they need to make as a living, right? Um, as stage four traders. So you'll see higher highs and higher lows in your equity curve. You have this patience and calmness about yourself that you have mastered some of your emotions, even though it's like not fully there ever with emotions, but you know when the time is right. And there's such confidence because you're not Trader Joe said this on this feed and he's long and I'm in cash. Am I doing something wrong? That is all out the window. You're just waiting for the market to turn and come to your wheelhouse. And then you're executing with full confidence. So the last thing that I'll say with stage four is it's not, there's it's not you're not perfect yet. You continuously continue to, read books, learn, attend webinars, um, listen to traders. There's new successful traders that come about. Like if we take a look at the USIC recently, folks like Marios, Leo, Leos, right? Um, Folks that, Richard's interviewing all the time. I watch all of them, and for me, I get a gist of what they're doing quite quickly because I can see and I've been there and done that. And I take certain aspects that I feel might help me still uh, to improve my system gradually as well, right? I'm still weak at, for example, um, I'd say, position sizing in the leadership names the right way. That never, even if you talk to Ross 30 plus years in, it's still something that is being worked on, even for him as a trader. So you're always trying to chase, I would say, that perfection, but you will never reach that perfect state, right? But you kind of still hack away at it, bits and pieces to consistently improve. So, Richard, if you want to add anything there.
Nothing much to improve. Just to reiterate what you said about stage four isn't like a destination. It's like just it's a constant state of evolution. You're still working to improve, like you said, still watching interviews, reading books, trying to pick up bits and pieces every there. Just it's about refinements. It's not necessarily about game changing changes. So stage four traders perform studies, gain new edges, refine their execution. They really focus on what they're own doing, their performance, their stats, all of that. and just refine everything that we talked about with stage three. So I think that's the biggest takeaway.